Today, all eyes are on the data from the American Petroleum Institute. Last week, the report showed a significant drawdown in the U.S. crude oil stockpiles. According to estimates, the United States could run out of its strategic reserves as early as the next spring. Today's data on the U.S. crude stocks will be of paramount importance in guiding the future dynamics of oil prices. If the American Petroleum Institute reports a continued decline in inventories, the asset will most likely break above $86 per barrel and head even for $87. News from China should also be taken into account. Today's trade figures showed that exports plunged by 14.5%, marking the sharpest drop since February 2020. The slump was solely due to the sluggish demand amid signs of a global recession. At the same time, China's trade surplus grew by $80.6 billion in July, beating analysts' forecasts. Nevertheless, pessimists greeted the data with concerns. From a technical point of view, Brent crude oil futures slowed down the upward cycle at around $87. The volume of long positions decreased, which led to a pullback. In a case, buyers failed to regain control of the market, and the benchmark may well fall below the 84 mark. According to the trading chart, the asset's bullish run is limited by the levels of 86 and 88. Besides, bear in mind that the oil market reacts to various factors, including global economic and political events, as well as supply and demand dynamics in the oil market. Therefore, it's worth being guided by both a technical and fundamental analysis to predict price movements more accurately. Obviously, Brent crude needs to break above the range of $86 and $88 per barrel to extend gains. Gold is still trading at around $1,935 per ounce, with the early signs of a weakening to $1,930. Given the extremely tight monetary policy pursued by major central banks, a gradual decline in its value is quite expected. So, gold is likely to extend losses, heading toward $1,900 per ounce. Of course, there may be rebounds and local corrections along the way, but they are likely to be short-lived. This week, the focus of gold traders is on the U.S. inflation data to be released on Thursday. The rate of consumer price growth in the country has a direct impact on further interest rate decisions by the Federal Reserve. The higher the rate, the more profitable it is to keep funds in the U.S. bonds. This in turn causes capital flows from gold to debt securities. And now let's move on the Russian currency. Yesterday, the dollar advanced as high as 97 rubles, but then saw a local pullback to 95. It seems that market participants have already put up with the dollar's possible rally to 100 rubles. It's only a matter of time before the greenback hits this psychological mark. Notably, it's a psychology that's a crucial aspect in this regard. After all, there are no fundamental factors contributing to a weaker ruble. On the contrary, the Russian currency should gain value, but market participants are stubbornly dragging it down. Probably things will only change after they reassess the situation. And that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow the news with us. And see you soon!